Well, after a fine run of form since July, we are seeing the US dollar uptrend give way. Are we going to see a bit of a chop fest coming through in the US dollar going forward? We are seeing better buying coming through in US Treasury, certainly on the long end of the curve, as a coordinated Fed talk term premiums. We look at US earnings in the session ahead, and we look at whether the bar is sufficiently low enough to see upside coming through in equities as a result. And we also preview the all-important US CPI print. This is the trade-off. Well, hello, I'm Chris Weston from Pepperstone, and I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics, and we're going to be going through all the navigation and charts and all the setups that are coming through in these crazy world of markets. Mr. Blake Morrow, I'm going to bring you into the program. I'm going to ask you one question to start off with. Did you buy some Birkenstock stock today?
Oh, I'm sorry, I was falling asleep. You did so many takes, I just literally dozed off there for a second. The answer to that question is no, I did not buy Birkenstocks. I refuse to buy Birkenstocks because all the teenagers here wear them, and I just won't do it, Chris.
Would you buy a pair of Birkenstocks over a pair of Crocs? You seem like a bit of a Crocs man to me.
You know, the unfortunate question that you ask means that my kid actually has both Birkenstocks and Crocs. So if I was faced with this ridiculous question for myself, I would have to go with Crocs. Because I can garden in them.
I reckon there's going to be a cheeky pairs trade in there somewhere along the way. Maybe a bit of a long Birkenstocks off. Long Birkenstock, short Crocs. I think that's going to be the trade for me going forward.
Yeah,
anyway, I think it's time to get serious, Blake. Let's go into Topical Thunder and see what's making these at the moment. Right, we're going to go into bonds because I think that's part of the reason we have seen risk assets moving up a bit sharply. We've seen a bit of reversal coming through in the S&P, NASDAQ and global equity markets. I certainly like what I'm seeing in Japan at the moment. I think the Nikkei may have some short-term upside there as well. And there's no doubt in my mind that the uptrend that we've seen in the dollar index, which has been in place since July, has given way. Doesn't necessarily mean you're going to see a collapse. Uptrends when they break don't mean that, but it does suggest to me that we could see a bit of sideways chop and one more for sort of the range trade mean reversionist to play through. But yeah, I think the idea that we'd seen this rampant sell-off in nominal and real rates. The 10-year Treasury got up to 4.88%. We're now down at sort of 4.55 or so. So good buying across the curve, but yield curves, which were at best steepening, have come and flattened out in the last week or so. And I think that's largely down to the raft of Fed members that we've been seeing talking about the idea that the capital markets are doing a lot of the job for them, and the rise that we've been seeing at the long end and the increased positive term premium means that's tightened financial conditions to the tune of about one rate hike, and therefore they don't really need to do it because the Fed, who are pricing a one run rate hike in the dot plot projections, the bond market's essentially done that tightening for them. So they've given us that message, and of course yields have fallen amongst other aspects. Beta buyers are playing through, and I think that the US dollar's come under a little bit of positioning unwind as a result. So that's where we are. The question is, after we have seen that move that we've been seeing in real rates and nominals, is this the time to see further buying and yields continue to move lower? And how's the trade there, Blake?
So, just looking at it just to make sure I had the date correct, if you go back and look at the 10-year lows and notes, which was back in October of 2022, we're quickly approaching that previous support, should act as current resistance from a basic technical analysis standpoint. I actually think that the bond market low is a tradable low. Tomorrow we're faced with CPI, and we're going to talk about CPI in just a few topics. And if it comes in a little hotter, based on what we saw with producer prices, perhaps we get a little bit of a move lower in the bond market, little rise in 10-year yields. But I think you can almost trade against that, knowing where the lows are at in the 10-year. I think the 10-year are moving up for a couple of different reasons. The reasons you laid out are succinct, and I would agree with them. I think the next topic is going to outline maybe some of the reasons why near term you might see buyers because they have options now. People have options. Investors have options now, Chris. I don't have to be in NVIDIA. I don't have to be in Microsoft. I don't even have to be in, XYZ electric company anymore. I can be in, treasuries and lock in a yield. And so I think that ability to have some diversification at these levels becomes attractive. So answer your question, green light, I think it's, what is when yellow turns to green, what color would that be? Anyway, lime green? Is it lime green?
Green. Okay. I'll ask my child. He's studying primary colors.
It did. Hey, you're closer to that primary color study chart than I am. Let me just put it to you that way. But I do like the bond market here, and that would be the end of my comments, Chris. How about you?
Yeah, I mean, I don't see massive downside unless. But I do think we've seen the highs in terms of yield and lows in terms of price at 488. I don't think we're going to get over 5%. But obviously, if we start making a move up, then I'll eat my words. But I think we've seen a high now. Obviously, let's see what happens with the CPI print this week, which we can talk about in a second. But I do think we've seen the highs. But it's difficult to make a case for significant lower levels until we see the service sector give up and we see unemployment spike up 30, 50 basis points. I think if you're bullish bonds, unfortunately, you're in a situation where you need the unemployment rate to move up 50 basis points, and that's when you're going to see a recession. So, you're sort of positioned or hedging yourself against sort of misery, I think.
Or you want to talk misery? Let's go ahead and jump topics, Chris, and let's move along. And let's move along to the unfortunate topic of what's happening in Israel. Something that obviously caught myself, I'm sure every market participant here by surprise. It's not a. I want to first of all say that I don't like to talk about these type of topics, not on a show like this. I don't want it to be political. I'm not a geopolitics expert. I have zero credentials as far as my opinions go in the Middle East. However, it is a situation that's been thrown upon us as market participants. So therefore, we have to kind of think about what do we do here, and I think that's appropriate at this point in time because it is a very unfortunate situation.
I agree completely.
100%. that is happening. But I want to talk about where the I want to say opportunities are, but maybe where the risks are. When you talk about risks associated with what's happening in Gaza and to what's happened in Israel. You're talking about crude and what the effects are there in crude oil. I think gold has caught a little bit of a bid on a risk aversion point of view, from a risk aversion point of view. Plus, you can obviously talk about yields and the dollar, but we also have the bond market, and I think the bond market is people are finding it attractive at this point based on what could develop in the Middle East. And then have to talk about the dollar too. The dollar has been sold for the reasons that you pointed out. However, if you start seeing the bond market, gold and bonds all rallying at the same time, I think you got yourself in a little bit of a, and VIX starts to rise, you throw that on top of it, you really have a situation where the market's getting concerned about these geopolitical risks that are now hovering above us as a cloud. So anyway, I wanted to get your thoughts. I took up a lot of time there, but what are your thoughts regarding what's happening in Israel, but how we should be positioning?
Yeah, I concur. And I mean, we are trying to price certainty. We're trying to price risk, and this is something that's very fluid. And we're not experts in this, so our ability to make the connections is very hazy. I think there was issues this week that the Saudis who are making noises about changing their output cut at the end of the year. That looked like they're probably going to extend that. We saw a bit of a pop in crude on those issues, and that's something that we're still watching, whether the output cuts that they've put in place would be reversed by the end of the year. That suggests that they probably will keep that in place for a period. We're still watching whether there's going to be sanctions being placed on Iran. We've seen President Biden step up today and say he's standing very firm with Israel. So we're watching to see how that develops. Iran have been exporting more crude recently, so we'll be watching that one to see if there's any kind of issues around that. But look, for me, I watch the market price action. The market tells me, and we're always a slave to price anyway. If we have a look at calendar spreads in crude, the difference between, say, 1 month and the 8-month future, that was trading at about a $10 premium, showing that the front months had been massively outperforming, and that's come to about $5. If we really thought that there was going to be supply issues coming through as a result of these geopolitical issues, then those calendar spreads would widen out. That's not happening, and crude prices are falling at the moment. So that's probably positive for risk in general. But I will say this is, from a market's perspective, if we were to see in the weeks ahead a spike up in crude, that's going to be inflationary for headline CPI. But at the same time, I think the market would see it as an accelerant to a recession in global markets, and therefore I think the market would buy gold, and I think they would buy bonds as a result of that. So headline inflation goes up, but a massive tax on the consumer, and I think that's where I'm seeing it. That's how I'm reading this at the moment.
And I want to just add one last thing before we move along these topics. If you're trading around the markets and you're like, holy crap, there's a lot of headline risk. You're not wrong. There is. So if you're sitting there looking at the market saying, I want to take advantage of maybe some moves that are happening, but you don't want to be blindsided by things that are beyond our control. Make sure you reduce your risk size and play defensive here and reduce your risk. This way you reduce your exposure in the markets. That's always the default safe thing to do in the markets during situations like this. So,
all right, we're going to go to. I'm going to switch gears and take it to US CPI now. This is the interesting one, Blake, because the market's got this really strong default position that we may see a little bit of volatility in the direction of travel with CPI in the next couple of months, but ultimately they've got a very strong view that in the next 12 months we're going to see headline inflation around 225, which is what's being priced in CPI fixings. So I think anything that sort of throws that journey off balance is where we're going to get the volatility. When market pricing has conviction around that and they question that judgment, that's when you're going to get dispersions in views and volatility. So this CPI number, I think, is going to be reasonably important. If you look at implied volatility around this number, it's not overly high, so people aren't expecting fireworks from this. Now, I think if we have a look at expectations for headline inflation, the market's expecting it to be at 3.6%. I think there's probably some modest downside risk to that if we look at CPI fixings. The market's betting that we're going to see around 3.55%, so slightly under. Month on month around 25 basis points or 0.25 of 1%. Core is going to be really interesting. They're expecting that to come in at 4.1%. Now, the way I'm looking at it, Blake, is that if we were to see above 4.3% on core, and we're looking at core services ex shelter and rents. If we were to see above 4.3%, then I think the market would say, hang on, that's not part of the script, and de-risk. The US dollar finds a new leg up. A 3 handle, though, on core CPI would be very welcomed indeed. That's the playbook I'm running with. How are you looking at it?
Well, I'm looking at it kind of the same way. And the one thing the caveat, I guess, is the pendulum has really swung against the dollar this week as yields have come off, and the dollar's been trading really heavy over the last couple of days. So even with the producer price number coming in hotter than expected, month over month, both core and headline. I got to say that the dollar still isn't performing that well. I think
it's a great point. If you told me that headline number, if you told me that PPI number yesterday, I would have said, the US dollar should have a nice run. And when something doesn't do what you want it to do, you've got to put question marks. And I think you make a really good point. I would have expected a much hotter reaction from the dollar. So I think it shows, I wouldn't say it's in the doghouse, but it's sort of been shunned outside by, to get there.
It is, and it's back below, kind of the breakout point. It looks like it could be very vulnerable here, but again, think about the risk. The risk, I think, at this point, because the pendulum has swung so far with the dollar just over the course of the last week, the dollar could really snap back on a hot CPI number tomorrow. Do Americans
call it pendulum, not pendulum? Is this like aluminum? Is this where you're going to get wrong?
I have it wrong. Just whatever I just said, it's wrong. Just assume that.
Okay, cool.
All right. Well, we're going to move along to something else. That we're gonna move on to the next topic because we are waiting for CPI tomorrow. But let's talk about banks because I think banks are like very overlooked at this point, and it's not something that's on everybody's radar because everybody has this assumption that banks, are going to make, gobs of money when interest rates rise. They can put in some juice on those loans. The problem is, Chris, is there's not a whole lot of juice there because there's not a lot of loan demand. And with rates where they're at, you're starting to see stresses from the bankruptcies, credit card delinquencies. Bank loans have screeched to almost a halt. So it's going to be really interesting to hear from the banks this Friday. I think let's see, I got a list of all the banks that we are going to hear from. We've got Wells Fargo. Well, there's more than this, by the way, but the big ones: Wells Fargo, Citigroup, JP Morgan, BlackRock, PNC, First Republic. I don't know if you've looked at First Republic stock recently. It's in the doghouse. And then I know you follow the regional bank index, which is going to be, it's KRE is going to be in everybody's radar going into the end of the week. And I think it's something that we need to be thinking about because rates have went up so far, so fast. And what are the banks going to be saying? I think you need to be sitting around looking for headlines, listening to, some of you will be bored enough where you're going to listen to the calls, but I would just be looking for the headlines.
The calls. Yeah, I guarantee no one on this show listens to a CEO call, but yeah, I don't know.
Okay, maybe I do some of the calls. Anyway, but the fact of the matter is that banks do matter, and it's Friday. It's going to be at the end of the day. It's going to be in the evening there for you in Australia, but I still think that you should be listening to what's happening. So what are your thoughts about the banks on Friday as they start reporting earnings?
Yeah, I've been pretty pessimistic on the KRE, on the regionals, but given the move lower in bond yields, you've actually seen sort of a better price action playing through. And yeah, it does feel like there's a little bit more upside in the KRE in the short term. I'm not trading it, but I feel like that's probably the probability trade there. In the big ones, obviously, we look at JP Morgan. That's your marquee bank. That has a sort of a premium. You kind of expect them to come out of good earnings. They've beaten EPS and revenue, I think, 6 out of the last 8 quarters. And Jamie Dimon just gets the job done. They're the best capitalised bank, best run bank out there. But yeah, I think if you look at that, I mean, there's the banks more generally, we're going to be looking at asset quality. Of course, we're going to be looking at asset quality. We're going to be looking at guidance around the asset base, whether there's going to be write-downs playing through. There could be some charge-offs that are taking through. We're going to be looking at net interest income, and those net interest income should actually be pretty good to the point where we're going to see EPS growth playing through. The banks, if we look at financial sector, actually expected to see about 8% EPS growth as a sector, which is going to be one of the best performing sectors or have the most anticipated EPS growth playing through because of what we've been seeing net interest income playing through there. So interesting. I've got my firmly on JP Morgan. The stock's been trading 150, 142, sort of caught in a bit of a range there. Yeah, they're similar with Wells and they've been sort of consolidating, missing a spark. The market doesn't want to bid them up at the moment, but they don't really want to short them either, to be honest. So it's kind of one or the other. Maybe this earnings season is going to be the catalyst there, but I do think you need to be watching the banks. I think you're absolutely right. What's happening with the demand for loans? Are we going to see a contraction demand for loans? What's the asset quality? It's going to be one there for the macro ballers, not just the bottom-up stock pickers. So I think you're right. I'm glad you brought this up because it does get overlooked. And I think the insights from your man Jamie Dimon and some of the other CEOs is going to be really, really, really important.
Agreed.
Yeah, nice. Let's go to that's the setup. All right, let's chuck it straight onto the yellow metal, Mr. Gold. Let's bring it in. Okay, so we've got a downtrend that's been in place. This channel that's been in place. Look at the support there. I mean, it was beautiful. It was like an orchestra of price action, and we came in and traded down to that 1810. Those lows that we saw. I think we talked about it last week on the channel. We hit the bottom of the channel. The buyers stepped in and said, I'll have a bit of that. And they've done really nicely. We traded through the 38.2% retracement of that recent move that we saw from September. We've seen good flow from traders ourselves, good two-way flow actually. But yeah, it feels like this has got a squeeze into that recent pivot low around 1880 or so, and then there may be a break of that takes us to the top end of the channel. I like it at the moment. I like the message I'm hearing from gold. The message I'm hearing from gold, Blake, is that rate hikes are over from the Federal Reserve. I think the credit market, the swaps market agrees. How are you trading this one right now?
Well, 1880. Well, you said 1880. I was looking at 1885. Tomato. We're horseshoes and hand grenades, as we like to say.
It's the swing, the August swing low, should we say?
Yep. And those are the levels that are going to be very important on this move back up. And I think, a lot of traders were looking for opportunities to buy it. And I think that you have to be looking at it kind of like the bond market. I think the tradable low is in. So any type of pullback, like let's say we have a hot number on CPI, dollar rallies a little bit, gold pulls back. I think you use that as an opportunity to be on the long side. If you can get long somewhere around the 1830 level, with risk below 1810 or 1805, I think that's the trade. I do like it to the upside, but am I going to chase it after a 60-point move higher over the course of the last couple of days? I don't want to. But again, you start looking at some of the risks that are surrounding the rest of the world right now, calling Middle East specifically, gold market might be that level, that might be that market that everybody ends up running to. So I do think it looks prime.
I want to try quickly go on just before. I think that the market is now saying that the next move is going to be a cut, but that cut's not going to come into 2024, of course. But the Fed are done. The financial markets have done. The other quick one before we move on to the NASDAQ is the idea that, very, very soon we should hear the round of voting for the new House Speaker, whether it's going to be Steve Scalise or Jim Jordan. If it's Jim Jordan, I think, gold prices have a bit of a pop on that one, to be honest, because he is so far on the right hand side of conservatism and fiscal hawk that he will appeal to the Freedom Caucus. He is a big member of that, but the chance of the US getting anything done under Jim Jordan and in the House is going to be very, very remote. We're going to see an extended shutdown, although the shutdown, when it comes, I think it will come, will be capped, because active servicemen in the military in the US, if you don't get paid, that's going to be a political shitstorm in the US, won't it, Blake? I mean, at the end of the day, if they miss a payment, active servicemen, if you miss 2 payments, then all hell breaks loose. So you've got a natural handbrake on how long the shutdown would last for, because it's just not going to happen. And of course, they do get back pay. But I think, Steve Scalise would be a neutral. But if we were to see Jim Jordan, the other person who's in the mix, then I think the idea that anything gets done in the House is going to be unwound. It's just not going to appeal to any Democrats to get done, and that majority in the House is so slim. So I think that's an interesting point that gold traders need to look at as well. Who is going to be the next House Speaker there?
And you're going to have an automatic tailwind for gold. So yeah, I think that's worth noting, Chris. Appreciate you bringing that up. All right, I'm gonna take us up to my first setup, which is going to be the NASDAQ 100. You could look at this as a flag pattern, which would be a bull flag pattern, meaning that we're at risk of an upside breakout. It's hard to think about the NASDAQ breaking out higher in this current environment, but at the same time, I've seen markets over the last several decades, Chris, move up and down, and you have no idea why the hell it's happening, but you kind of got to go with it, right? So we're at channel resistance, and we're within about, let's just say 100 points, give or take, of that channel resistance. Also, if you believe that stocks are mispriced and they should be shorted, this is you're getting towards a risk reward level where you're going to get a good pivot. So I think this is a setup, Chris. I don't have any skin in the game as far as the NASDAQ 100 goes, but I think it's worth noting that, a breakout higher above that trend line, because we're back above the 50 DMA, could put us right back at trend highs, above 15,600. The flip side is, a reversal here. Next thing you know is we're trading down at 14,400. So what are your thoughts here regarding the NASDAQ?
Oh, look, mate, this is a great setup, and thanks for bringing it up. I think it's. I mean, I'll ask you a question. I mean, if it does prove to be, a bull flag, and we won't know until it's actually complete. Obviously, I mean, if you look at the extension of where that technically could target, it's. I mean, what's the target on it? It would be. You're looking for a massive new bull market, right?
I mean, it is a brand new bull market, and we're going to the 127% extension, all-time highs, 18.4, 18.4, 18.5.
Yeah, I mean, and I love these. I love these bull flags. I mean, obviously, it still needs a bit of work. It looks like gold on steroids in that last chart. But so I think this is one that everyone should be watching. I mean, the trade that I put out last week, which we've been involved with, is short Russell, long Nasdaq, and that trade continues to work. I think that's a sort of a lower beta way of trading this, and I think that continues to work really well. All those banks, regional banks, are supporting the Russell to an extent. But I think, if this completes, I think there's going to be a lot of people talking about it, and I think you go along for the ride. Think less, make more, effectively in that situation.
There you go.
Yeah. Anyway, let's go to CAD Swiss. This is a viewer question that we had from one of the viewers from last week. You can see, I would appreciate the CAD Swiss analysis if and when possible. An interesting one, because we've been talking, Blake, about CAD Swiss over a number of shows. I think it's probably where we've been seeing people come back to us on this one. Obviously, we've got that downtrend breaking out. We had a really, really powerful move coming through. The CAD obviously taking in a lot of the venom that we've been seeing from that recent the spike higher in crude prices. Before we've just seen that collapse recently. But when we saw that really strong move up in there, the CAD was reverted back to that correlation in terms of trade, and actually, we saw the CAD actually having the strongest correlation with WTI crude. And obviously, we got back into that horizontal resistance, literally touched at the T, and then it's just been down, 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 and we can see we're just about to go and test that 61.8% retracement of that level. I think this has got further downside. I think that crude prices have got further downside in the short term. I think if we look at the way the curve's trading, the way the price action on front months trading, I think there's further downside. And so I like this to be short. I think we go and test that 61.8% retracement, maybe get a bit of a bounce into that. I'll be selling rallies off that retracement level. But the downside is where I see the high probability. Blake, how are you seeing that one?
Well, one of the things I want to say regarding the Swiss, and I know we're going to be stacked up on Swiss pairs, so this is going to apply not only to the CAD Swiss but also the Aussie Swiss. If you take a look at the dollar Swiss currency, it is breaking down. It's got a double top, false breakout to the upside. It's breaking down, heading towards an ascending trend line, which is, I don't know, I'm off the cuff. It's maybe about 100 pips away for further downside, which means that the Swiss franc is being bought right now against a lot of different crosses, not only the CAD, but you're seeing it against the dollar as well. And we'll see how it looks against the Aussie here momentarily. But Chris, I got to say, Swiss, it does look like a safe haven currency. And in this type of environment, Swiss francs seem to be like the hot ticket right now. And with that being said, let's just take it over to the next setup, because this is a viewer question. It's interesting, Chris, how we had two viewer questions also on Swiss pairs. This is from Eduardo. So thanks for writing it in, Eduardo. It's the first thing I thought of when I pulled this up is the double top in the dollar Swiss is going to give a nice tailwind to the Swiss franc. The Middle East heating up, not such great terms, but it's also bringing in Swiss demand. Then you take a look at like a currency like the Aussie Swiss, which, by the way, the Aussie has been holding up fairly well. But what you're going to see here, Chris, is that we have some support, horizontal support, right at the 57, 60 level. And just below that's a 50 DMA. We start snapping through those levels, through those stops. I think the Aussie Swiss could make another plunge to the downside. Look at the overall arching trend from left to right. It's moving down, and it's making lower highs, and maybe we'll end up making lower lows. So anyway, what are your thoughts on the Aussie Swiss? I got your feelings on the
well, I think it does feel like the times they are changing. And I've actually turned a little bit more constructive on the Australian dollar. I think that the market, if we look at China, I think we're seeing interesting times there. I mean, the Chinese government just announced they're going to issue $137 billion of bonds, which takes the deficit above 3% of GDP, which is something that they projected in March. So they're blowing out the deficit, which is something that's really uncommon in China, and they're issuing more debt, and that will be supportive of infrastructure and growth. I think we're seeing a better trend in the Chinese data flow, and that should turn, amongst other factors, more constructive on the Aussie. The question is how you trade the Aussie, and it's not against the Swiss franc in this situation. You're doing it against other currencies in a similar boat. But yeah, I think with the Swiss, with that defensive situation, I think we are finding qualities about that. But the technicals are screaming out now. I mean, if this goes down, if this breaks through those levels, we're putting sell stops there. I'll go along for the ride. So despite the fact that I'm turning tactically a bit more constructive over a medium term on the Australian dollar, the charts, they ain't lying, and I think that's got downside. They ain't lying. So I think there's I think the way that you do this is around the execution of your trade. You can see there's a really long-term downtrend. We've had that sort of swing up. We're sort of going, is this going to go? Put your sell stops below the market and let the market just, the gravity take it, and let that ride take it there. A currency in motion stays in motion. I can't remember who said that. It was one of the famous scientists back in the day. We know who that is. But yeah, I think that's the way you execute your trade. Sell stop orders, let the momentum trade it and take it down, and we continue to ride that. But turning a bit more constructive on the Aussie, Mr. Blake. I think it's an interesting one there.
I'll save it for the play of the day.
Let's go to play of the day. Well done. All right, well, I'm going to, in play de jour, I'm going to go sterling CAD. Now, I've coined this one. It's ugly, but I like it. I think that's something my wife says about me every day. But now, why do I say that? Is because, there's not a lot to like about the pound, to be honest. I mean, we are going to be waiting for the next CPI number comes out on the 18th. A couple of days after that, the retail sales number. And that's obviously, we are very much focused in the UK on what's happening in the service sector and the impact that's had. All these service-led economies are looking very closely at that. The PMI numbers were pretty awful recently. But the market's telling me a message here. You've got a really good double top in play after a nice snapback. And the way that I want to play this is, again, similar to what we've been seeing in Blake's Aussie Swiss play, is looking to do buy stop orders above that level. Now, of course, a lot of these do fail, and there's a good chance it will fail, in which case you want to stop out very, very close and very quickly. But there's also a good chance, given that this is kind of like a very concentrated cup and handle pattern, that this could really ramp up and move into markedly higher on the back of this. So I'm fairly negative on the CAD, as we talked about in the last one there, but I just want to do this tactically. I'm putting buy stop orders above the market, and I'm just looking to ride that momentum. I like what I'm seeing in the price action, and maybe there's a situation where some of the data flow in the UK has maybe got a bit negative. We're not pricing any rate hikes in the UK, and I think that's led us to a much more clean structure. But then again, I think the Bank of England are done. But yeah, just tactically looking to trade momentum, trade a breakout, and ride this one higher if it comes.
All right. Well, my play of the day, Chris, is going to be against your Aussie idea, and it's going to be the Euro Aussie. Now, I've mapped it out really nice for everybody here. The thing is, I'm looking at it from a risk reward play, and I'm looking at it, and you'll notice the title, Bracing for Impact. Look, last week, shorted New Zealand yen. It's kind of up in my face right now, still respecting that longer term trend line, so I'm not so worried about it. Chris, your comments regarding the Australian dollar does, I do think about that. And I think about how well the Aussie has been performing in this environment. However, the Euro Aussie has popped out of its channel, and you can see the longer term channel marked in blue is really the risk. And it's really below the 618 that comes in at 1.6328. That is your low risk. That's that lower bubble that you see down there. The smaller bubble, that would be kind of your entry around that trend line. And then I'd be looking for a move back above the 50 DMA and maybe back up towards 170. It's a good risk reward to play in the longer term trend. And if things go a little, how should I say, tits up in the market, that means on your back, the market's on its back, tits up, right? That means that if that happens, the euro tends to outperform the Aussie in situations like that. And I think the Euro Aussie will benefit from a little bit of risk aversion if we do indeed get it. So that's my play of the day, Chris.
Very good. And you've been having fun with circles as well. I think I'm channeling my inner Michael Brown, who'd say something similar to that. Oh, he's got his crayons out. But yeah, no, it's good. I like it as well. But I think, the Aussie as well, I think we really need to see Chinese markets outperform. To see some capital flying through the northbound connecting net. I want to see equity markets outperforming in China, and I would like to see obviously some strength coming back into the yuan. If we were to see that, then you will see Blake's trade under pressure. But if we were to see the yuan weaken off, then you're going to do well. But I think for the Aussie to really outperform, given that structural these things are turning, now we need to see for the Aussie to be a proper proxy, you need to see yuan strengthen, and we need to see the Chinese equity markets outperforming, and maybe some of the property stocks looking a bit better as well. And that's where you're going to get the big outperformance from the Australian dollar in that situation. So look, the markets are changing around. We're seeing, it's interesting, Blake, that we're not doing a huge amount of plays on the US dollar, and I think that's because we are seeing this structural change after this really nice one-way move based on exceptionalism and resilience and other factors. We're now starting to see a bit of a chop, and that's probably why we're not looking at that one so closely. But the markets are changing. We could see that Nasdaq flying up. Gold's looking interesting. It's telling us a message, and these markets are dynamic, and we need to be reactive as such, and that's where we are at the moment. Anyway, thank you all for all your questions and your comments. Last week we got a load of them, which is really, really good to see. If you're staying around for this long, then give us a like. We'd love to see that as well. And smash us up for your viewer questions for next week, or any kind of setups that you like the look of yourself and just want to sort of get in on the mix and tell us how you're seeing things as well. So we'll see you more for next week for more of the Trade Off.